Aaron Fragnito here. My partner Seth Martinez is also on the presentation, and we're going to talk about how to self-direct your IRA into real estate tonight. Now, this is a similar PowerPoint presentation to what we do often in other weeks with investors, but this presentation, we're going to focus more on the IRA portion of it, the IRA information, and we're going to explain how we allow investors to crack into this North Jersey market, which is really a high demands, hard to enter market. There's very high prices, there's rules and regulations, there's rent control, there's a lot of demand, there's a lot of competition to get a good deal in North Jersey. And we're going to talk about how we find those discounted apartment buildings, how we work with passive investors to buy those buildings, and then how those investors make returns and build their wealth passively without having to do the heavy lifting. And we're going to explain how people do that with their IRA. And that's the focus tonight. So our mission overall at People's Capital Group is to transform our personal finances and quality of life by creating passive income streams through real estate investments. So I read Rich Dad, Poor Dad coming out of college, and it really changed my whole mindset on what wealth is, what I wanted to do with my life, and how I was going to build my fortunes. And I found my passion in real estate. And I read, Robert Kiyosaki there, the moment you make passive income and portfolio income a part of your life will change. So that's Rich Dad, Poor Dad, a very popular real estate book. If you haven't picked that one up, give it a read. It's 100 pages. You could bang it out in a weekend. Great book. And so Seth and I started People's Capital Group in 2013. I actually started as a realtor. After I read that book, I made a list of what I wanted to do. And I said, okay, I want to be a millionaire in 10 years. I want to have $100,000 of passive income, $1 million in net worth in real estate. And how am I going to get there? All right, I had no money and no experience in real estate about 10 years ago. So I learned the business by becoming a realtor. I met Seth. I met other investors who were buying properties for pennies on the dollar and improving them and making great cash flow. I learned how to flip houses. Seth and I fixed and flipped over 50 houses. We wholesaled over 100 properties. We're a resource for investors, but we also are a resource for passive investors who are looking to get passively invested in real estate. So together we formed People's Capital Group in 2013. I'm more in charge of investor relations, marketing, and branding, where Seth is in charge of the operations and managing the management company. Seth, you want to chime in here and chirp in and explain a little bit about how you got started?
Sure. Thanks, Aaron. So my name is Seth Martinez. I'm more of the operations side of People's Capital Group. Aaron is more of the branding and investor relations side. But together we try to help people get involved in real estate. A lot of the clients that we work with, the partners that we work with, have had a lifetime desire of getting into real estate, but they were in many cases hesitant to pull the trigger. They didn't want to do it alone. They were scared. They didn't have the knowledge. They were very busy. And so we like to help people get involved and make it easier for them. Some of our other clients have been in real estate a long time, and they still want to be partnered with us because, again, we make it easier for them to invest. So my background, though, before I met Aaron, which was about 10 years ago, was in healthcare in Manhattan. I started a business with my brother in 2003, sold it in 2009, and took about a year off, consulted for the old company or the new company that bought our company. And during that consulting period, I found Rich Dad, Poor Dad myself, and I had heard a lot about it a long time earlier, and I didn't read it because I thought it was like a fad. And then when I did read it, I was kind of kicking myself for not reading it earlier. But so I read the book. I got into real estate. I moved to New Jersey, started working with Aaron as a realtor. He was really the only realtor that wanted to deal with an investor like me. A lot of the other realtors were hesitant to deal with investors or take a lot of offers, things of that nature. So we realized we worked well together, and we started People's Capital Group a couple years later in 2013. It's been about 7-8 years now, and one of our passions now is not just to build the company, but to, again, help people come along for the journey, take part in the benefits of real estate with us as we grow and grow together.
Great. Thank you, Seth. Thank you very much. All right. Excellent stuff. And so, yeah, together we've done about 250 plus transactions, and we manage an 8-figure portfolio today. And so tonight we're going to talk about number one, why do people invest in apartment buildings in New Jersey? How do they self-direct their IRA into apartment buildings, and why New Jersey apartment buildings? Number two, why do IRA investors prefer a syndicate investing, which is when you pool capital together and buy a bigger building? And number three, why do people value PCG's service here to move their retirement account safely into real estate and not have to worry about the headaches of running around and managing the building and finding a great deal, getting the financing, all those fun things. So we're going to talk about all those details tonight. And first, we're going to start with a touch on the COVID situation right now. Of course, so far, more good news these days than we've seen in the last few months. So it looks like we are flattening that curve, which is great. And the market is actually hot right now for some of our sales. It's interesting. We have multiple bids right now. Seth, I'm going to unmute you here. How many offers do we have on that 7 unit in Newark? What do we have, like 4 or 5 offers right now?
Yeah, we have about 5 offers, and we're trying to finalize it this week. So if anybody wants to buy a 7 unit in Newark, let us know before we accept one of these offers.
You know what? I think you missed the boat on that. When there's 7 offers on a property, you're not going to get a good deal. So rule number 1 of investing, be the only buyer in the room, right? That's how you get a good deal.
Or invest with People's Capital Group, because we tend to get off-market deals and be a little less competition.
There you go. That's what it's all about. Off-market deals, being in touch with the seller directly, or having really good relationships with brokers. So we're going to talk about that, and that's our secret to how we find these deals. So we're going to work that into the presentation, but let's talk about our single family houses. That market is a little less predictable. We do flip houses. We have a single family division. That's not what we're talking about tonight, but it's important to know that, because that's a part of the business that is a little bit more hit or miss. There'll be years where we've made $1 million flipping houses, and that's great. And there's other years where you're just not going to make that. The values aren't there, the deals aren't there, the resale values aren't high enough. So apartment buildings, number 2 on the list here, really are, in our opinion, a more consistent, longer-term investment. Okay, I personally put my money into apartment buildings. I personally like owning cash-flowing real estate, where if we lose a tenant or two, the building continues to cash flow because they're large buildings. And even in these tough times where we have a surprise pandemic, which is pretty much the stuff we talk about, these these black swans that come into our economy and really harm them, which is this pandemic. Our buildings are still strong with collections through these times. We're still buying buildings. We're still analyzing buildings. We're still doing well with our current holdings. And that's because we have our own management company, but also because apartment buildings in high demand markets are good long-term investments. Self-storage is also a good place to be, but you better bet people are going to pay their rent for their home before they pay their rent for their junk. Office and industrial is very soft. It's been soft. It's getting softer. Office space is kind of a thing of the past, the way it was done with these big offices in the past. Retail, storefronts, unfortunately, online shopping has caused that to be something that isn't really a very hot topic right now. But hospitality and senior housing is also a very hot area that is really saturated with a lot of big companies that are in that space. So we actually focus on apartment buildings. That is our specialty. We do not do too much in the other spaces except single family houses, which right now is fully funded and a part of our business that is flipping properties in New Jersey. So strategically, our way forward at this time is we're just treading very lightly. We're making very great investments, as we always are, but also renegotiating prices lower. We have a big transaction we're moving forward on right now, a nice 25 unit in Patterson. And actually, we did negotiate that lower. We're in the midst of finalizing that. And that's something that is super important these times, to make sure you're renegotiating, retrading, that when there is an economic event that turns the market, as we've seen here, although it is coming back strong, we hope that continues, you still want to negotiate a discount, and that's exactly what we've done with our acquisitions. So whenever you're looking at a syndication, a place to park your capital, your hard-earned money into real estate or into any asset class, the first thing you want to do is educate yourself, which congratulations, started doing by just jumping on this webinar. Second thing, work with experienced investors. You want to work with people with at least a 10-year track record. We have a 10-year track record here in real estate in New Jersey, and we focus on one market, which is really what separates us from a lot of our competition. Also, take into consideration your degree of risk, your value of play. How much risk are you open to? Are you doing new construction on, beachfront property in Miami, kind of high risk stuff? High risk, high reward, or you're doing more turnkey apartment buildings in high demand markets within an hour of Manhattan, more, longer term, safer investment through thick and thin type of investment. So you got to decide, where do you want to be? And maybe you want to diversify into both, more risky investments, less risky real estate investments. Location. Listen, the truth is you can make real money in real estate in a lot of locations. Okay. But the bottom line is if the operators know what they're doing and have a good track record, you have a much higher chance of making those returns that are projected and perhaps hitting over those returns. So you want to look at location, your operators, the history of the market, the history of the operators, and educate yourself about real estate in general before you jump into any investment. But once you recognize the value of passive investing in apartment buildings, you also want to sit on the sidelines for too long and wait for the right opportunity to come along, because guess what? There's never any perfect opportunity. It's more about teaming up with a group you're comfortable with that has a good long-term strategy that has proven that worked in the past and continue to make it work in the future. So anyway, why do investors like New Jersey? Let's talk about this for a second. New Jersey rents are below the national average, which indicate high earnings in the labor force with room to increase rents. Okay, wages have rose in the past in 2019. Rents rose in 2019. We recognize things are changing right now with the market, and rents actually continue to stay strong in these areas. Newark, Berkeley Heights, we own real estate in both these areas. And our rent collections are still strong, and the rent growth actually continues even through these difficult times. We have people really renting out our units aggressively now. And, when we have any vacancies, we have a line out the door to lease the units. So that's good news for the middle of the pandemic. Just really shows that multifamily housing holds its value when managed in the right markets. So New Jersey is highly skilled workforce, ranks number 1 in education, number 3 in median household income. It's the state's 20 Fortune 500 companies, number 1 in drugs and pharmaceutical jobs, and number 2 in foreign direct investments. So really a hot market here in Jersey, a lot of demand to live here. Not so much, we don't focus on New York City or the boroughs in New York City. We focus on New Jersey and the North Jersey market. And we work a lot with IRA investors who are looking for legal tax shelters, predictable investment returns. And what we find is that about a third of our investors self-direct their IRA or convert their 401k into their IRA and then self-direct their IRA into real estate. We're going to break that down, how you do that tonight. And that allows them to fund important occasions in life, long-term occasions. And again, it's a lower risk investment. We do feel that by buying bigger properties in high demand markets where, let's say, a boiler breaks in a 2-family and it costs $5,000 to fix it, well, that can be 2 years of your net income on a property there. So that's a big challenge. You might erase 2 years of income from one boiler breaking on a 2 or 3 family property. On an apartment building, if you lose a boiler for $5,000 or so, you have a repair of that level. It's really not going to knock out your cash flow for all that long. You should have reserves in large buildings, and that allows the buildings to actually cash flow better through vacancies, through repairs, through recessions, and therefore bigger buildings are safer investments and make stronger rental income and better returns over time. We have a lot of smaller buildings, 2s and 3s. It's how we got started. There's nothing wrong with that. But we actually have active investors that come to us and own 2s and 3s and manage them themselves and personally guarantee the mortgage. And they come to us and they say, hey, when I invest passively with People's Capital Group, I actually make the same returns I make when I own 100% of a 3-family. Or I make better returns with People's Capital Group, because even though we're managing it and owning a piece of the equity, by sharing the risk and investing in a larger property, the returns are better for our investors. And of course, we find discounted, mismanaged apartment buildings within an hour of New York City, and that allows the demand to rent those spaces to maintain a high demand in those areas. So again, about a third of our investors self-direct their IRA into well-managed New Jersey apartment buildings that have shown that they do fare well in recessions. And we do have predictable cash flow from these buildings and predictable tax depreciations, where something like the stock market or an index fund is not predictable. okay, and other tax depreciations as well with real estate, and a kind of a wash through with your IRA. But that allows our investors to pay very little tax, even if they're not using their IRA, and that allows them to just keep more of your money. So the less you pay to the tax man, the more you get to keep. We also have a long-term strategy with multiple exit options, but also really we have a 15-year indefinite investment opportunity with our buildings as we use the 1031 tax deference to trade into bigger buildings after a 10 to 15-year period. So therefore, an initial investment in People's Capital Group, if you choose not to exit, could just be the gift that keeps on giving as far as we trade into bigger buildings as time goes on. That allows us, our investors, to fund important occasions in life like weddings for their children and college and travel, getting on a plane, going on a vacation with your family, because we manage everything from A to Z with our management company. We send detailed monthly updates. We also have quarterly financials, very detailed quarterly financials, and we make tax time very easy as well with your tax forms getting to you quickly. We personally guarantee the mortgage so our investors don't have to. Okay, if you were to call up a few friends and gather some money together and go buy a 10-unit property town over, well, that would be doable, but you'd have to personally guarantee the mortgage. So when getting a mortgage on a piece of real estate, if you don't get a mortgage, you're really just not going to cash flow that well. And so to get a mortgage, you generally have to personally guarantee it, unless it's a mortgage above $3 or $4 million. And by personally guaranteeing it, you're going into a whole nother level of risk, being personally liable for that debt. So Seth and I personally guarantee the debt so our investors don't have to. That is a huge amount of risk that we're taking off our investors' shoulders, putting on our shoulders, because we know these buildings are going to succeed because we manage them day in and day out with our management company, and we know the high demand to live in these areas in the North Jersey market that allows you to commute to Manhattan in less than an hour is going to stay strong even with the market up or the market down. And the one thing we do know is the market's going to go up and the market's going to go down. So you want to be in an asset class that continues to cash flow through those turmoils of the market, and big apartment buildings allow us to make that cash flow where vacancies hinder us less, repairs hinder us less. And by buying in areas where we commute into Manhattan, say Newark, New Jersey, or Paterson, New Jersey, or Elizabeth, or Jersey City, okay, we don't buy a whole lot in Hoboken because Hoboken's overpriced. You don't cash flow well in Hoboken. We make our best returns in Newark and Paterson, New Jersey. Inner city areas, downtown inner city areas. We buy Class B and Class C real estate. We don't buy the fanciest real estate, Class A. We don't buy the lowest rung of real estate, Class D. We buy middle-of-the-road apartment buildings, and this allows our tenant base to be strong. This allows a high demand of people to continue to want to rent these units because we spruce up the building, we improve the common area, we make it a more desirable place to live, and therefore tenants are happy to pay a higher rent. And we also attract good tenants paying higher rents. Higher rents equal better returns for our investors. So why do people prefer syndicated investing? Okay, so this is when you pool capital together and you buy a larger building. Well, first off, you don't have to manage the property. It's managed by a group of experts here who've been doing it for 10 years, who have developed a management company that's not meant to just call a plumber when the pipe leaks and collect the rent when it's due. We actually take mismanaged buildings and we turn them around. Maybe there's a lot of people on payroll for no reason. Maybe they're not taking advantage of storage in the basement or parking or other ways to make more income on the property. Maybe the rents haven't been raised in 10 years. Maybe leases haven't been renegotiated properly. So we look for opportunity to add more income on the real estate and also lower our expenses, therefore improving the value of the real estate as well and the cash flow of it. And this allows our investors to make quarterly cash flow checks. We do a refinance strategy every 4 to 5 years where the investors have an option to exit the investment and get back their entire initial investment. We'll talk about that in a little bit. And but by syndicating capital together, right, by pooling capital together, now something like a $30,000 investment can own a part of a $3 million building. Normally, $30,000 isn't going to get you a whole lot of real estate in North Jersey. It's not really going to get you much at all. So in North Jersey, if you want to get into high demand markets, they're not cheap. You know, we're not overpaying for real estate. We're getting good prices on it. We're also buying in the more affordable areas, like inner city areas in North Jersey. But at the same time, there's a price to pay to get into high demand markets. So for $30,000, our investors can get started with a $3 million or $4 million building that offers passive cash flow and good long-term returns, where normally a small investment like that really just wouldn't be able to do much in real estate. So by syndicating, you can get invested in a larger, safer building with a smaller investment. Of course, people like the idea of tapping into expert real estate knowledge, being lifted up above the pitfalls. And it's taken Seth and I years to acquire this expertise. So this allows our investors their free time where they don't have to deal with the complex financing. So we personally guarantee that mortgage, and that allows our money to be cheaper, our debt to be less expensive, allows us to get better interest rates and better terms in the debt. And the less we're paying for the mortgage, the less we're paying for the money we're borrowing for the property, the more all of our investors and us earn on the real estate. So by Seth and I personally guaranteeing the mortgage, it makes better terms, allows for better terms on the mortgage, and that allows us to make better returns for our investors. So once we buy the building, okay, first thing we do is we find a mismanaged apartment building. We'll look through hundreds of properties to find a good one, and we'll negotiate a great price, and then we'll have a value add strategy. Okay, we're going to renegotiate leases. We're going to find out more ways to make income on the property. We're going to lower our expenses all through improved management and physical improvements, some investment in the building as well. And that's going to force equity in the building. Okay, so there's two types of equity in real estate. There's forced equity, which we control, which I just explained. And then there's natural equity, which happens with inflation. Also, buying real estate in a high demand market, maintaining it well over the years allows for natural inflation as well, a natural for equity growth as well. So between natural equity growth and forced equity growth, we build the value of the real estate, and we have a nice 3 to 5 year exit strategy where we refinance the building, and investors have the option to exit the investment and get back their entire initial investment, or the investors can stay invested long term, which is a better tax strategy. You talk to Natalie, she would suggest staying invested long term to avoid the capital gains tax, and that's what our investors tend to do, is stay invested long term. Because when you're investing in a syndicate, you are raised up above the pitfalls, and we'll invest $10,000 a month, find good properties, and we'll cherry pick those properties 1 out of 400 and bring them to our investors. And that's why our investors continue to appreciate these off-market deals we bring them. They're just really nice cherry picked properties, opportunities in high demand markets. So we have 10,000 investors in our network. We work with active investors and passive investors, and we also have about 250 properties. We completed about $40 million in transactions. We're about a $10 million asset right now, but actually $11 million. We just bought $1 million property last week, and we now have about 86 rental units. We bought 11 units last week. So there you go. We need to update our PowerPoint here as we build our portfolio. We also sell buildings sometimes. We had 100 units recently, and then we just sold some and we bought some. So that's part of being a real estate investor and buying and selling apartment buildings as time goes on. So PCG takes on the risk of repaying the banks by personally guaranteeing that loan. Now, not only are we on the hook for that mortgage, but that makes sure, you better bet, we're going to hit our mark for our projections, because we are personally on the hook for that mortgage. And not only do we only make our money by hitting those marks as performance-based pay, but also when you're on the hook for that mortgage, you need that building to perform. So Seth and I always get the best performance from our buildings. And Seth, you want to talk a little bit about that?
Sure. Thanks, Eric. Okay, so why do people value People's Capital Group's service? Well, as it says here, it's an aggressive calculating business model that we have. And basically it involves a few things: setting a high standard for creating value, for dealing with tenants, dealing with banks, dealing with realtors, dealing with landlords. We want to set a high bar and a high standard and build a good reputation, but also a good rapport with everybody we work with. And that's very important. So we use a professional approach for the entire process, for each transaction. That actually goes to before the transaction too. So negotiating deals, marketing for deals, and so forth and so on. Our ultimate goal with that approach is to give our investors the quality of life that they are looking for when they invest their money. So that's very important. And it really starts, again, finding the deal. Our philosophy is that great deals are not they don't come to you. You have to create the deal, and that comes through negotiating. also through relationships and just knowing the market and knowing how to deal with landlords and as also realtors. So we spend a lot of money finding deals, and we market that money out on a monthly basis. But 95 out of 100 deals really are not going to be good, and even the 5 out of 100, even those deals you have to really negotiate to get the great deals consistently. So our investors like the way we bring them those deals. Okay, so another thing our investors like is that we give them more free time, as Aaron was saying. A lot of our investors are working a full-time job. They have a career, a passion that they're dealing with, that they want to focus on. And when they invest in something, whether it's stocks, real estate, commodities, whatever it might be, they don't want to take on a new job. They just want their money to be working for them, and they want to be invested and diversified. But again, they don't want to have a second job, and that's why syndicating can be very valuable to them, because it doesn't cost any time. They just get paid. They take the advantages, as Aaron said, of the ownership of real estate, the cash flow, equity growth, tax depreciation, but they don't have to spend the time to get all that. So that's very important. Okay, the ultimate goal for the forced equity appreciation part, as Aaron was saying, increasing income, decreasing expenses, is to create more passive income and to do it with a higher ROI and less tax consequences. And when you're taking a gain from real estate versus a gain from, say, stocks, it can be tax-free, particularly if you don't sell it. If you sell a gain in stocks, there's a capital income tax there, so capital expense. So very important to know that distinction. If you go to the next slide, we have property management, and we bring a very aggressive approach to property management as well. We want to deal with tenants in a strong but professional way, in a fair way, but also very, very strong. We want to know the laws in each municipality. In New Jersey, the way it's set up is that the state in Trenton dictates the laws, and then they give certain leeway for each municipality to apply the law, such as rent control. So in New Jersey, some towns have rent control, some do not. Some have certain limits, some have higher limits. So we want to know all that before we buy the property. And another thing that our investors like, they don't have to keep up on all the rent control laws. That's one of the advantages of investing passively. But property management is critical to being successful. It's also critical to not burning out as a real estate investor. And typically the burnout timeframe, if you're managing your own real estate, is going to be about 2.5 years. And even if you have a property management, you still have to manage the property manager. So, but when you invest in a syndicate, you don't have to manage the property management. The syndicator or the operator will, like People's Capital Group. So knowing how to manage the property is critical. It takes years to learn. And we have a track record of success. Our collections right now, pre-pandemic, were close to 98-99% on most properties. Post-pandemic, it's been closer to 90 to 95%, but those numbers are going up. Okay, if we look at the next slide, we're going to talk about the exit strategy. So it's important for us to offer our investors an easy way to exit an investment. Our typical investments are 3 to 5 years. But when that time comes, we want to make it easy as possible to leave, as we said. So it's up to our investors. They can decide. We usually have a 3 to 6 month window prior to the end where we ask our investors to notify us. And if they want to exit, that's totally fine. They basically have two options at the end of this period. So if they want to exit, they take their profits and they take the return of their principal and they move on. So, of course, they have to talk to their accountant, make sure they understand the tax consequences. But it's their choice. If they don't want to exit the LLC, they can remain invested. They can take their profits up to that point, but they can keep their principal invested. So again, very important for us to make it simple and easy and as fair as possible, and our investors like that. And then power of syndicated investing. We've worked with dozens of investors over the past 8 years, and now we're at the point of adding new investors and accepting new investors into our network. and our community of investors as we grow. So we're looking to acquire about 100 units in the coming 12 months or so, and we're looking to bring on new investors along with that journey. So we look forward to hopefully maybe working with you if you qualify. There is a vetting process for everybody that comes on board, but we can have that conversation down the road. So Aaron, I'm going to pass it on back to you.
Thank you, Seth. All right, excellent stuff. So we went over the exit strategy there, and I'm going to break into a couple case studies here, and then we're going to really talk about the IRA part of this presentation. So here's some properties we bought in the past. Here's a small 5-unit in Newark, downtown Newark, near the Rutgers University area there. And we negotiated a good price, about $20,000 below the asking price. We bought a 5-unit in Newark in decent shape, right around Rutgers University for $110,000. They were asking $130,000, and then we put about $30,000 into it, which is not a lot of renovation. So lipstick on a big pig. Sometimes less is more. We're not doing a ton of physical renovations to these buildings. We're really just improving the management, improving the cosmetics of the building, some of the appliances, but overall, not looking to get a ton of permits or architectural drawings or add levels. We're keeping it simple. You tend to make better returns in real estate when you keep it simple. In 2014, the value of the building was $310,000 based on improved management and renovations. So we bought it for $110,000. We put $30,000 into it. Let's say we're into it for $150,000, $160,000 with costs, and we were able to refinance the building, and it appraised at $310,000. So we pulled out about 70% of that $310,000. So let's say about $200,000. So we got back our $160,000 investment or so overall, and pocketed a lump sum of capital on top of that. The investor got their entire initial investment back and then got a lump sum of capital. So really great opportunity for this investor. We had a different agreement with him at the time, and our split then went to 20-80, with us owning 80, him owning 20 after he got back his initial investment. But then again, in 2017, we refinanced one more time, and the investor got another lump sum of capital. Today, he continues to get cash flow on the building and tax benefits. So that's a small building, but in a decent area. Shows how when you buy a good building in a good area and maintain it and improve it over time, not huge improvements, but just good improvements that go a long way, more so improving management and maintaining strong management of the building. Well, that's how you build the value into these pieces of real estate, and that's how you get these successful cash out refinances, not to mention better cash flow. So here's a 25 unit we bought in 2014. We sold it in 2017. This was a building they were asking $1.2 million for, and we paid $1.075, so $1,075,000 for it. So we were able to capture about $125,000 equity right off the bat. And this allowed us to get a good price for our investors, and that's our job. Look through a lot of bad deals to find one good one and bring them on a silver platter to our investors. In fact, it's so hard to find a good deal. The easy part is putting the capital together because of our track record and our relationships. But the hardest part of our job is finding a good, discounted, mismanaged apartment building in a high-demand North Jersey market. They just don't come around that often. So when they do, our investors jump on them quickly, and so do we, of course. And that allows our investors to put their capital to work quickly and effectively in this market. But quite frankly, the hardest part of our job is finding a good deal. And this was another good deal here. So we acquired a bank loan on it for 75% of the purchase price. We had a 4.5% interest rate on it. We're getting interest rates around 3.75 now because Seth and I personally guarantee the mortgage. Now, this is in 2014. Interest rates are actually lower than they were back then. I remember back then they were saying, oh, get your mortgages now. Rates are low. Look at that. Rates are actually lower than they were back then. Another reason why apartment buildings and long-term good debt is a smart place to be during these times, because the cost of debt is so cheap right now. 3.75, that's crazy. So in this case, we're paying 4.5, and our investors brought in $100,000 each. It's not always that clean. Sometimes we have some investors with $30,000 and $300,000, but in this case, we had 4 investors with $100,000 each, and they each obtained 10% ownership, and that was the investors obtained 60% ownership, and they were able to obtain that ownership and make a nice return investment. We had a 40% ownership in the building, and we sold the building for $1.35 million about 2.5 years later. And that allowed our investors to make about a 26% return on their investment. and over about a 2.5-year period. So about 11% cash on cash return. And I believe we projected about a 9.5. So we really try to under promise and over deliver. Right? That is what it's all about. When you are looking at real estate and trying to identify what are the rents going to be in 5 years, in 3 years, in 15 years, okay, what's the value going to be in 3 years, in 5 and 10 years? How are we going to take this building from being a mismanaged apartment building to a piece of real estate that's desirable, that people want to rent, that people are more than happy to pay top dollar in rent for, and investors are proud to own? That's what we do to find those deals, to create that strategy, to execute that strategy. And about a third of our investors will take their IRA and they'll self-direct it into a building with us so that they can get all the benefits of owning the building without having to do the work. It's a way to diversify your IRA out of the stock market, be more recession resilient, and actually put your IRA into inner city areas and make a difference. Okay, a lot of our IRAs are sitting in an index fund. Maybe they're in a bunch of different companies. Maybe they don't really even play a role in any actual company. It's just some made up fund, right? Who really knows what funds are, where this money actually goes sometimes, and who is actually helping. So in real estate, when we're buying, say, a 25 unit in downtown, Paterson, New Jersey, well, you know that, okay, we're going to take your hard-earned IRA and all of our investors' capital, we're going to put it in this building, we're going to execute a value add strategy, we're going to make a difference in this building. We're going to improve the lives of our tenants. We're going to go from maybe a slumlord owned it before, and now we own it, and it's a much better, more desirable building, and the tenants are much happier. So in this case, your IRA is actually making a difference in inner city areas. And a lot of our local investors, you don't have to be local, but a lot of people are local. About half of our investors are New Jersey, New York investors, just because naturally it's fun to invest locally. But a lot of our investors are from California or Georgia or Florida or Texas. So, people enjoy the North Jersey market no matter where you live in the country. But people really enjoy putting their IRA into inner city areas. There's a real discrepancy between the income in North Jersey. You go to Paterson, you go to Newark, you go to these areas and you say, wow, these are really struggling inner city areas. And I'm happy, I'm proud to put my IRA to work in a building that maybe was an eyesore before, but is now a nice apartment building with happy tenants and a nice place to raise your family where tenants can be comfortable and live. And that improves the area and that improves the buildings around it. And over time, your investments in these buildings and our work with these buildings can lead to a better society there, a better neighborhood, improved home values, a safer neighborhood, and a happier tenant base, which performs better returns for our investors. So here's how you self-direct your IRA into real estate. The first thing you need to do is find an IRA custodian. Okay, an IRA custodian is a company that you have to work with to self-direct your IRA. There's tons of them out there. You could easily do a Google search. I can even put you in touch with someone who has a program that compares IRA custodians and their costs. And, you basically shop around and find the right IRA custodian for you. Once you select an IRA custodian, you're going to fill out the paperwork and hire that custodian. It's usually not that much to get started with them. And they're going to contact whoever holds your IRA now or wherever it is, or if you have a 401k you need to allocate or something like that. And they're going to work with you to put that IRA together and self-direct it over to the IRA custodian. Okay. Once your IRA has been self-directed to the IRA custodian, at that point, if you're just looking to make one or two passive investments, then you can select those investments. Say you're comfortable with People's Capital Group, you reviewed the offering memorandum, and you've qualified for the investment, and you've decided that this is the next step you'd like to take. It's a good fit for your investment needs. And you tell your IRA custodian to self-direct your IRA into an apartment building with People's Capital Group. Okay, it's not a way to pull from your IRA early. It's not a way to, cheat the tax man and take from your IRA when the IRS isn't looking. But it is a way to build your IRA faster, diversify out of that stock market, and have a more predictable return, more predictable type of cash flow on your IRA, more predictable big lump sum upon the cash out refinance. And just know that your IRA is actually making a difference in the inner city area. And get updates as well. Our investors love my updates on the properties. They're very in-depth. I try to educate our investors as well as make solid returns for them. But we really prefer to give our investors an experience where they understand what their capital is doing. It's not like investing in a hedge fund or some type of index fund. you don't just get a spreadsheet that has a number on it. Every month, I mean, you're going to get that every quarter, but every month you get an actual update on what's going on with the property and the difference your capital is making in that building. And every quarter you get detailed financials, of course. Every year you get the tax K1 tax returns, but it's important to read that monthly update, understand, learn real estate, learn how repositioning mismanaged apartment buildings work. And by that, it's a nice experience to see your IRA at work there. Okay, let's say you wanted to do a couple things with your IRA. Let's say you wanted to flip a house because you saw a show on HGTV about flipping houses and it looked pretty easy. That's kind of a joke because honestly, the hardest dollar I ever made in real estate was flipping houses, but that's a whole nother seminar. So let's say you want to try it though. So you're going to start an LLC. Okay, you're going to need access to your IRA very quickly, right? Your money very quickly. You're going to need to pay the contractor. You're going to need to pay the landscaper. You're going to be actively needing access to this money. So it doesn't make sense to leave it with your IRA custodian because every time you need a check from your IRA custodian, it's a few business days and there's a cost to it as well. That's not a problem if you're making one investment into an apartment building with People's Capital Group or another syndication, and that syndication's paying you back cash flow checks every quarter. That's fine. You're really only moving the money once, so you don't have to take this extra step and start a self-directed IRA LLC account, which is what I'm about to explain. But if you want to do active things with your IRA, and you're going to need access to that money very readily. Now, remember, you can't take your spouse out to dinner. You can't put your kids through college. There's rules what you can and can't do with your self-directed IRA, and it's up to you to follow them once you create this LLC that's owned by your IRA and managed by you. Once that LLC is created, you can then our IRA custodian will be directed to move that IRA into this LLC. Okay, and this LLC is going to be owned by your IRA, but it could be managed by you. Now, you can't pay yourself a management fee. Again, you can't use it to buy a vacation home and take your family there for free over the holidays, okay? There's rules and regulations what you can and can't do with your IRA, but if you follow the rules, you can go ahead and flip some houses and maybe buy some income properties or, invest in your brother's business he always wanted to start, and be careful with that one. And, that allows you to really do different things with your IRA and ideally build it faster and stronger. So because of that, if you're going to need the money more readily, you're going to want to start that LLC that's owned by your IRA and managed by you, and that's called a self-direct IRA LLC account. You don't have to do that. There's more risks to doing that. Now it's up to you to do the right things with that IRA. But if you want to go flip houses and you're going to need that money readily, then that's the right thing to do. Now, if you're going to be more passive with your IRA and just invest in syndication and get nice quarterly cash flow checks in the mail, then really you don't need to start the LLC. You can just self-direct your IRA to an IRA custodian of your choice, and then you will direct that IRA custodian to move that investment into People's Capital Group, the LLC we create for whichever building you've decided to invest in at that time, whatever our private offering is. And our operating agreement is set up so that IRAs can invest in our LLCs. Okay, so we start a new LLC for every purchase, and when we do that, it's structured just so that IRAs can get in there. Of course, passive cash investors as well, but our IRA investors are about a third of our investors, so we make sure that our operating agreement is IRA friendly and our investment syndication is IRA friendly. All right, so let's talk about three different types of investors we have worked with in the past, continue to work with today. So a common investor we work with is a high income investor known as an accredited investor. An accredited investor means you have over $250,000 in net income or over $300,000 including your spouse, or you have over $1 million in net worth not including your primary residence. If you don't meet that cut financially, you still may qualify to invest with People's Capital Group. We'll talk about that in a second. But a lot of our investors are accredited, which we prefer. And those investors tend to be high income earners that are highly taxed and also own large stock portfolios. Stock portfolios produce dividends, but real estate produces cash flow. Cash flow is written off with tax depreciation where dividends are not. Now, if we're talking about IRAs, it's all tax advantaged, so that's a bit of a moot point. But we do feel that real estate, especially apartment buildings, well managed and high demand markets are more predictable and more recession resilient than being invested in the stock market. We also work with active real estate investors. We have a whole nother business of that wholesales residential properties. We have a whole website and business that does that. Great profitable part of our business. And a lot of those active investors that are buying fixer-uppers from us say, hey, you know what? I jumped on one of your webinars the other day, and I like what you guys are doing. Let's invest in a building. So, they take some capital, say $50,000 from a flip. They put it into a building with us, and over time they say, wow, I actually make more or better returns investing in a large apartment building with People's Capital Group than I did owning a 2 or 3 or 4 family where I'm running around, always on call, guaranteeing the mortgage, managing the property. Smaller buildings, filing the taxes. Tax time's a headache if you don't have the right team in place. So by working with People's Capital Group, tax time is more, it's easier. Our K1s are filed. Our CPA coordinates with your CPA if you have one. If not, a lot of people end up working with our CPA for all their tax needs because they're so good. And we work with a whole third-party CPA firm, accounting firm that does all of our bookkeeping and tax filing so that our investors are given all their tax forms in a timely manner. It's so important that we make sure you get the forms in a timely manner, the K1s, the quarterly informs of as far as how the investment's performing, the profit and loss statement, the balance sheet, the distribution sheet to see what all the investors are earning. So it's important we get this information out to our investors quickly and effectively, and that's why it's all done by third-party professionals that know exactly how to do bookkeeping or know exactly how to do tax filing. Right? That's not Seth and our specialty. We're a specialty in we're specialists in the real estate investment category, and we have professionals that handle all the other categories of our business. So that's all done properly and in a timely manner, and that makes a happy investor over time. So a third type of investor we work with is an IRA investor. That's who's on the webinar tonight. And I hope you enjoy this webinar about how to self-direct your IRA in a real estate. A lot of IRAs are managed by brokers with fees. We don't have an asset management fee. We don't take 1% off the top. It's really crazy how many fees IRA brokers can charge sometimes without even really disclosing them or how hidden they are, or just really, wow, I made 4 or 5% return on my investment, but I paid 1.5% in fees. Well, that's 20% of your returns went to fees. So you gotta understand that. What are the fees you're really paying your brokers? So we've structured a non-fee business here where we get paid when we perform. And we get paid when we purchase the building, we close on the building, when we create positive passive cash flow for our investors, when we achieve our refinance goal. These are the times Seth and I get paid, and it's when our investors get paid as well. That makes sure that we're performing to get paid. We don't get a fee off the top. We don't get here or there. We don't get a salary. It's all performance pay. We have to close on the building. We have to perform. We have to create that value for our customers and our investors before we get paid. So that is how our pay works over here at People's Capital Group, and that's called performance pay. So a lot of IRA brokers do not have that. Also, IRAs are mostly invested in the stocks, which of course are very volatile, less predictable, more vulnerable to recessions, as we've seen with these times. And as I was saying earlier, when your IRA is invested in a hedge fund or some index fund, you don't see the results in your local community. So a lot of our IRA investors really like putting their IRA into an inner city community and improving that community. It's very tangible. It's incredible how tangible it all is. It's a lot of fun to see your money improving a neighborhood. So we've worked with over 30 investors. Many of them are repeat investors. We've made a goal in the last year or two to reach out to new investors. We don't sell books. We don't sell CDs. We don't sell boot camps. We're not your guru. We don't do the education thing. We work with investors looking to build their wealth in real estate, looking to get a nice quarterly cash flow check in the mail, quarterly financials with monthly updates, learn about what we're doing, earn money passively, but also not have to do all the heavy lifting. So if that sounds like something you'd like to do with your IRA, then you do have to qualify to invest. Now, the hardest part for us is actually finding a good investment opportunity. So once we do find a good opportunity, it generally fills up very quickly because we have a good track record. We've worked with a lot of investors for 10 years, and quite frankly, they all keep coming back and looking to put their money to work. Because once you make good returns for an investor, under promise, tell them you're going to make 9.5% and then you create 11%. Well, those investors tend to come back as happy investors. And that's exactly what our goal is year over year here at People's Capital Group, under promise and over deliver. But if you do want to get invested and at least learn about the next steps to get invested to qualify People's Capital Group, I'm going to put a link actually in the chat that you can jump on. It's a link to our website where you can actually qualify as a passive investor. So I'm going to stop the share for 1 sec here, and I'm going to go over to our website, and I'm going to grab that link. Now, if you click on this link, it'll bring you to a form to fill out, a simple form, take a few minutes. And if you fill out this form, you'll be able to, we'll respond to you as far as if you qualify or not for an investment. We work with accredited and sophisticated investors. So as I was saying earlier, an accredited investor is someone that earns over $250,000 a year individually, over $300,000 with their spouse, or has a net worth of over $1 million, not including their primary residence. Now, if this is not you, you may fall into the category of a sophisticated investor. A sophisticated investor is someone that understands the investment opportunity, has some real estate investment experience, and has the minimum investment of $30,000, but we actually prefer double that. So really has a $60,000 investment with only $30,000 we would allow you to put to work with People's Capital Group. We'll never take your entire investment amount. But here at People's Capital Group, we do work with accredited and sophisticated investors that I just explained. I put the link in the chat. So if you do feel like you meet one of those categories of a sophisticated or an accredited investor, you can click that link in the chat, and that will allow you to go to the application to qualify, and we'll get back to you in a timely manner to let you know more about if you qualify or not, the next steps. If you do qualify, once you fill out the application, and then you'll want to set up a call with me, we'll do a 15-minute call. I'm going to go over our next offering. It's a beautiful property, great opportunity in North Jersey, and our investors are lining up for it, and actually spots are filling up very quickly. So getting in on this investment, you'd have to act pretty quickly. You'd want to click that link tonight. You'd want to fill out the application, and we could set up a call probably by Friday or so to learn more about this next opportunity. At that point, I would send you the offering memorandum after our call, and the offering memorandum will go over all the details of the investment, and we could set up a one-on-one meeting to go over that as well if you're qualified to invest. So guys, that's it for tonight. I'm Aaron Fragnito of People's Capital Group. We talked about how to self-direct your IRA into real estate tonight. We talked about why we buy apartment buildings in the North Jersey market. And we also hopefully explained how we separate ourselves from our competition by having an in-house management company that allows us to actually control the assets 100% and therefore have more manageable income over a long-term period, right? And that's what it's all about. If you're trying to build wealth, this whole stock market up 30%, down 30%, it's too volatile for a lot of investors, especially your IRA. Okay, there might be a part of your investment capital you want to be risky with. Go buy some Bitcoin. Sure, have some fun. But you really need to put your IRA partially into a safe long-term investment. And that's what I've personally done with my capital. And that's what many investors have done for years and years with apartment buildings. So we continue that trend, and we buy apartment buildings in North Jersey, and we manage them to a T. And we've been doing this for 10 years. So if you'd like to get on board here, like to qualify, fill out the application. I put the link here in the chat. You can click that if you'd like to fill out the application. That's it for tonight. I'm going to see if we have any questions here. Looks like Natalie put our information up, which is great. But that's it for now. I'm Aaron Fragnito of People's Capital Group. If you have any other questions, you can email us at info@peoplescapitalgroup.com. There's our phone number as well. And you can also visit us at peoplescapitalgroup.com. And soon we'll start having events again in Berkeley Heights, in-person events. But for now, we'll continue these webinars. And hopefully we can connect and get you qualified to invest if this is a fit for you. If not, I think you just learned a lot about how to buy and reposition apartment buildings and self-direct your IRA into real estate. So hopefully you learned a thing or two. Have a good night. Thank you.